Your VA mortgage can carry up to $6,000 of insulation, windows, or a heat pump. The catch is that this door can disappear at closing.
And the amount is a ceiling, not a promise. The improvement and documentation must fit, so must the lender review and timing.
For a purchase loan, that distinction matters when a utility bill is already squeezing the household budget.
The VA Loan Guarantee Service describes an EEM as a way to roll approved permanent energy-saving improvements into a VA guaranteed purchase or refinancing loan. This current VA page is the primary source receipt. It is not a free grant and not a second check after closing.
Wait, Erica, refinancing means any refinance? Which refinance route actually counts?
No. The buyer's guide names a VA purchase loan or an interest rate reduction refinance loan an IRRL. The EEM must close at the same time as that VA loan.
This route is not for you if you need a standalone renovation loan or want to add work after closing. A potential fit starts with an otherwise eligible purchase or IRRL borrower, permanent energy-saving work, and lender approval before the same closing.
That same closing rule is why the first conversation belongs before the loan package is final. A contractor bid discovered after the mortgage closes cannot simply be stapled onto the old note.
So the practical hook is not just $6,000. It is $6,000 with an expiration point.
Precisely. A borrower still has to qualify for the VA loan and find a lender willing to process the EEM. The file must document eligible work and satisfy underwriting. Nothing in the program turns approval into an entitlement.
Before the loan closes, the work must be physical and permanent. This insulation installation is the kind of improvement the VA guide actually names.
The clean first question is, will this fixture stay with the house and reduce energy use? That filter eliminates a surprising number of wish list purchases before the lender spends time on them.
Let me test the timing with a real buying sequence. A veteran finds a house, sees thin attic insulation during inspection, and plans to replace it after moving. At what point does the EEM conversation start?
Before the lender locks the final scope and prepares closing, the veteran should ask the lender how it wants the contract to estimate, whether it needs an energy analysis, and how the amount changes underwriting. Waiting until the keys are handed over loses the same closing path.
That answer also prevents a common language mistake. An inspection recommendation is not an approved EEM scope. It identifies a condition. The lender still needs the program documentation that converts a proposed permanent improvement into a financeable amount.
And the EEM amount becomes part of the mortgage balance. Projected energy savings may exceed the payment increase. Even so, the borrower should understand the new principal and payment. The escrow arrangement and total financing cost matter too. Savings and affordability are related, not identical.
That is the money hook with the hype removed. One closing can finance useful permanent work, but the household still has to live comfortably with the new loan. Before Friday, ask one lender one exact question. Do you originate VA energy efficient mortgages? And what bid format do you require before closing? Let me pause for just a second, because this genuinely helps. If you are getting value here, hit that like button, then subscribe and ring the bell. It costs you nothing, and it is the single biggest thing that keeps these videos coming.
Permanent is the word that decides this scene.
Show me the boundary, because a refrigerator can save energy too.
Start with insulation or other work attached to the home. The renovation scope should measure and describe it.
The VA Buyer's Guide lists solar heating or cooling. It also lists caulking and weather stripping. Furnace efficiency modifications and clock thermostats appear too. So do added insulation, storm windows or doors, and heat pumps. The examples are not exhaustive.
The refrigerator fails because it is an appliance and not a permanent fixture under this program.
That distinction has a second edge. Correct. VA excludes new construction and luxury items such as spas. Non-permanent fixtures are out too. So is work that does not reduce energy consumption. A desirable home improvement is not automatically an EEM improvement.
The source says heat pump, but that does not mean every replacement quote wins. The lender still needs the cost and proposed work. The upper tier also needs projected savings analysis.
What about replacing old windows because they look dated?
Appearance alone is not the program purpose. The file should connect the proposed window work to energy efficiency using the lender's required documentation rather than a sales slogan.
That is why an itemized bid beats a round renovation number.
Name the fixture and labor. Add the cost and energy purpose. The paperwork should let the lender see exactly what the dollars buy.
Now run the same test on 3 purchases. Added attic insulation can fit because it stays with the home and reduces energy consumption. A portable space heater fails because it is an appliance. A decorative fireplace surround fails because appearance is not energy reduction.
A furnace modification may fit, but a full replacement quote should still explain the efficiency change. A storm door may fit, but an ordinary door chosen only for style needs an energy rationale. The noun alone never proves the program purpose.
So I cannot circle heat pump on the VA list and assume any invoice with those 2 words is approved.
Correct. The listed example gets the proposal into the proper conversation. It does not replace the bid or cost review. When required, projected savings analysis still applies. Appraisal considerations and ordinary underwriting remain. The source opens a category. The lender evaluates the file.
Also separate repair urgency from EEM eligibility. A failed furnace may need immediate work, but the mortgage process still has documentation and closing steps. If the house needs emergency repair before closing, ask the lender and real estate professionals how that affects the transaction rather than improvising.
What if one contractor, quote, mixes insulation with drywall repair? Then it adds new lighting and a kitchen appliance in one total.
Ask for separate line items. The lender needs to identify which work is permanent and energy saving, which work merely restores disturbed surfaces, and which items are outside the EEM. A blended total can hide an ineligible appliance inside an otherwise eligible insulation project.
Do not decide on your own that related repair is automatically financeable. Give the complete scope to the lender and ask for a written determination. When the boundary is unclear, a documented question is safer than trimming the description until it sounds eligible. One caution: this footage shows people reviewing a house contract, not an energy audit. Your own lender decides what estimates, reports, or certifications the actual file needs.
$3,000 in documented improvement cost is where the proof changes.
Below that line, documented improvement cost is the core amount test. Above it, through $6,000, the lender must also certify that projected monthly energy savings exceed the added monthly payment costs.
Now the calculator compares projected savings with the payment increase. The borrower does not invent the inputs.
The current VA explanation divides the benefit into 2 bands under a $6,000 ceiling. Up to $3,000 is based on documented cost. From $3,000 through $6,000, projected monthly energy savings must exceed the mortgage payment increase.
So a $50 projected saving and a $40 payment increase can fit the arithmetic. A $30 saving and a $40 increase does not.
Chris, that is an illustration, not a quoted rate or a promise about anyone's bill. The actual analysis belongs to the lender's file and the improvement documentation.
Energy models predict weather and household behaviour still change the bill, fuel prices and the home's condition matter too. The lender certifies the upper tier test. It does not ensure the exact future savings.
And there is no $7,000 exception hiding behind a better audit. VA says EEMs over $6,000 are not permitted.
$6,000 is the scoreboard ceiling, not $6,000 in a persuasive cover letter.
A rare case where the footnote is shorter than Chris's meal prep recipe.
The recipe is chicken. The rule is still $6,000.
There is another subtle point in the upper band. The lender compares monthly projected savings with the monthly cost created by financing the improvement. It is not simply comparing the $6,000 project price with 1 year of utility bills.
Professor Sorensen, that means the term of the mortgage and the actual pricing of the loan affect the payment side of the test.
Yes, and that is why online examples cannot approve a live file. The interest rate and remaining IRRRL balance belong in the lender's calculation. So do taxes and insurance. Financed fees and the final improvement amount matter too. This episode explains the rule but cannot quote the result.
Borrowers should request the two numbers in writing: the payment increase attributed to the improvement and the projected monthly energy savings used for certification. If the lender will not provide the calculation, ask what document in the closing file records it.
Then stress test the household case. If the projection assumes ideal operation, ask what happens during unusually hot or cold months. Program eligibility answers whether the amount may be financed. Household planning answers whether the borrower wants that financing.
Listen to this NDSU extension demonstration of why insulation and air sealing have to work together. It also shows why the project itself needs a real technical basis.
The educator compares wall and spray foam insulation, then shows how air sealing around electrical boxes and the rim joist stops uncontrolled air transfer.
The watched segment is educational context, not a VA cost certification. Bring the contractor's scope to the lender and ask who must produce the savings analysis for this loan.
The EEM and VA loan close together. The money does not normally leave closing as a home improvement shopping balance.
It moves into an escrow-controlled sequence.
Improvement funds are held in escrow. That makes the completion file part of the benefit, not clerical cleanup.
VA's current explanation says the improvements generally must be completed within 6 months after loan closing. The funds are held in escrow until the lender verifies completion and provides written notification to VA.
Generally is doing real work there. Borrowers should ask the lender what deadline and extension rules appear in their own closing documents.
And ask what counts as completion evidence. It may be invoices and an inspection. Photographs or contractor certification may also matter. The program summary does not replace the lender's escrow instructions.
The same closing rule also prevents a timing error. The EEM is part of the purchase or IRRRL transaction, so the scope cannot wait until a later renovation decision.
Kim, what changes if an IRRRL raises total PE et E by 20% or more?
Here is the 20% trigger. Start with the new principal and interest payment. Add taxes and insurance to get PTI. If that amount is 20% or more above the old PTI, the lender must certify that the veteran qualifies for the higher payment.
That changes my answer. A lower interest rate does not erase the qualification check if the total payment rises enough after the improvement amount is added.
Exactly. Compare the full old and new PT figures, not just the note rate. A 20% or more increase activates that certification requirement.
The threshold is not 19.9 rounded up for convenience. Ask for the actual old and new PT, then ask for the percentage change and qualification conclusion. Those 4 fields show why certification was or was not required.
And the 6-month clock begins after closing, when moving boxes and contractor schedules are already competing for attention. What keeps the file from slipping?
Schedule the contractor before closing when the lender permits it. Identify who will verify completion and calendar checkpoints well before the final date. Keep change orders visible to the lender, because a different scope or price can affect the approved escrow.
Do not treat the contractor's final invoice as the only record. Preserve the original approved estimate and any lender authorization for changes. Keep proof of payment where required. Save completion evidence and the lender's written release or verification notice.
That is 5 checkpoints. First comes the approved scope, then scheduled work and authorized changes. Completion evidence follows. Escrow release closes the loop. A project can be physically finished yet administratively unfinished.
If the contractor proposes a substitution, pause before approving it. A different window or thermostat may change cost and performance. The same is true for insulation systems or heat pump models. The lender should decide whether the approval still covers the revision.
If work is delayed, contact the lender before the deadline rather than after it. Ask what written notice or explanation is required. A revised schedule or inspection may matter too. The word generally does not create a private extension.
and keep the escrow contact beside the contractor contact. 2 phone numbers, 1 calendar reminder, and 1 folder can prevent the finished project from becoming an unresolved loan file.
This is the best moment for a lender review. Confirm the approved amount and escrow instructions. Confirm completion proof and deadline. Then record the exact new PT.
5 fields. Put them on one page before signing. If any field is blank, that is the next question, not a future surprise.
The first call asks whether this lender originates VAEEMs. That answer determines whether the benefit stays real or becomes a search result remembered too late.
Do not ask only whether the lender makes VA loans. Ask whether that office currently originates VA energy-efficient mortgages and who owns the EEM documentation.
Bring the lender's requirements and household budget to that call. A financed improvement still changes the payment and projected savings.
Question 1. Which permanent improvements will you consider? Question 2. What estimates or energy analysis do you require? Question 3. What purchase or IRRRL timing must those items meet before closing?
Question 4. How will the escrow release work? Question 5. What proves completion? Question 6. Who calculates the payment increase and projected monthly savings for an amount above $3,000?
6 questions, 1 call. That is a real training plan.
Compare the payment increase with projected savings. Do not sign a contractor agreement that depends on EEM money until the lender confirms the scope and timing. A contractor saying VA approved is not the lender approving this loan file.
Okay, so if the loan closes in October, hang on. Count from the actual closing date and use the written escrow deadline. The general 6-month rule is not permission to guess at an April date.
I also want a no-surprise question. If the project costs more than the approved EEM amount, who pays the difference and when?
That belongs in writing before close. Exactly. Ask how overruns and substitutions are handled. Ask about canceled or incomplete work, too. The VA summary gives program boundaries. The note and escrow agreement govern transaction details. So do the contractor contract and lender instructions.
Then ask the lender how the appraisal treats the project. The EEM amount rule we reviewed does not answer that separate appraisal question. Keep the payment analysis and appraisal response in different columns.
One project has 3 scoreboards. They are payment, energy use, and home value. The EEM rule directly tests only specific program requirements. The household still judges the broader decision.
And compare alternatives without double counting. If a utility rebate or tax incentive may apply, ask the relevant program and your tax professional how it interacts with project cost. Do not subtract an uncertain incentive from the lender's figures as though cash were already received.
The safest file shows gross project cost and the EEM amount. It separately shows any borrower paid difference. Verified incentives get their own column. Clean columns prevent an attractive headline from hiding a funding gap.
When the work is complete, inspect the installed fixture and match it to the approved scope before asking for escrow release. One more question is worth hearing answered directly. Can a heat pump save energy without guaranteeing a lower dollar bill in every house?
Listen for the distinction between energy savings and cost savings.
The University Extension educator explains that heat pumps can deliver energy savings while cost savings depend on the existing heating fuel and the household's reasons for changing systems.
That is Chris's savings test in plain language. Finance the project only after the technical estimate and the household payment both survive scrutiny.
Do not start work on an assumption. Ask whether the lender originates VAEEMs. Document the scope, cost, and savings analysis. Verify the escrow and completion rules, then compare the payment increase with projected savings. I printed those 6 questions on one page, and I am proud of it because a veteran can use it before a closing date turns the benefit into a missed chance.
A concise page. We have achieved bureaucratic minimalism.
Borrowing Professor Erica's favorite ruling, the document wins.
If this gave you a useful lender script, like the video and subscribe for the next overlooked veteran benefit. Which permanent upgrade would you price first if your VA lender offered the EEM route? Make the call before the closing clock starts. Until next time, take good care.